All right. Okay, I think we're ready to get started. Good afternoon, everyone. Welcome to our Bastiat Society of Washington, D.C. event this afternoon. My name is Steve Dewey. I'm the director of our Washington, D.C. chapter. The Bastiat Society is the public outreach program of the American Institute for Economic Research, otherwise known as AIER. The purpose of the Bastiat Society is to provide a forum for advancing the ideals of free market economics and sound money, property rights, personal liberty, and a free and civil society. If you'd like to learn more about AIER and the Bastiat Society, our website address is aier.org. This afternoon, I'm very pleased to have Paul Kupiec as our featured speaker. Dr. Kupiec is Senior Fellow at the American Enterprise Institute, where he studies systemic risk and the management and regulations of banks and financial markets. He also follows financial regulators, such as the Federal Reserve, and examines the impact of financial regulations on the U.S. economy. For his talk this afternoon, Paul will discuss the recent failure of Silicon Valley Bank on March 10th, which was the second largest bank failure in U.S. history at that time, with over $200 billion in assets. Silicon Valley Bank's failure and the contemporaneous failure of Signature Bank sparked contagious depositor runs at several banks, prompting federal regulators to invoke a systemic risk exception and guarantee all of the deposits of Silicon Valley Bank and Signature Bank. He will discuss the causes behind the failure of Silicon Valley Bank, including the problems with federal regulatory oversight and the systemic repercussions across the banking sector. A brief summary of Paul Kupiec's background before his current position as a senior fellow at the American Enterprise Institute. He was an associate director at the Division of Insurance and Research within the Center for Financial Research at the FDIC, where he oversaw research on bank risk measurement and the development of bank regulatory policies, such as the Basel III regulatory framework from the Bank of International Settlements. He was also chairman of the research task force of the Basel Committee on Banking Supervision. He also previously worked at the International Monetary Fund, Freddie Mac, JP Morgan, and the Division of Research and Statistics at the Board of Governors of the Federal Reserve System. Paul Kupiec earned his Bachelor of Science degree in economics from George Washington University and his doctorate in economics with a specialization in finance, theory, and econometrics from the University of Pennsylvania. For our discussion this afternoon, we've scheduled it to go till 1:30. Our featured speaker's presentation will be for roughly 40 to 45 minutes, which should allow plenty of time for Q&A session with attendees. So now I will turn it over to our featured speaker, Dr. Paul Kupiec. Paul, over to you.
Thanks, Stephen. So when Stephen asked me to do this talk, I think he had probably just read I did testify in the Senate in early May and that testimony focused on SVB Bank. And he asked me if I'm willing to come and give a talk about it, and he wanted me to cover all the banks that had failed. And as Steve remembers, I kind of sighed and said, gee, that's a lot of work to study all those banks. And so maybe if I have time, I'll try. Well, I did, actually. So my talk is going to be a little more encompassing than just SVB Bank. I'm going to cover all four banks, and I'm going to try to explain the commonalities in the economic environment and the regulatory environment, what's going on in the last 3 or 4 years that have caused these four banks to fail. So, summary slide to start with, the economic environment. We had massive COVID fiscal stimulus, we had near zero interest rates, we had massive Federal Reserve quantitative easing, where they bought in lots of mortgage-backed securities and treasuries. And I'm going to look at the four banks that have failed thus far. Is the crisis over? They've sort of got it tamped down for a while. Some of the problems that led to these banks failing, I think, are manifest in other banks in the system, maybe not to the same degree, but the longer the Fed has to keep rates higher or raise them higher, some other banks in the system could easily come under pressure. So when I do research papers, academic type research papers or things of the past, you come at a problem and you ask a question, and often you work through all kinds of complexities, and you kind of come to an answer, and it's really complex, and there's this fact and that fact and that fact, and I find as you go through time and you digest all the information, your understanding of the problem gets much sharper. And the people who really understand what's going on can usually explain it to you in one sentence. It doesn't take all the complexity and the science and the sophistication once you really get to the heart of it. So what's the common nutshell in these 4 bank failures? All 4 of these banks really operated like Securities Exchange Commission money market mutual funds, like your Vanguard money market mutual fund, except they didn't have the money market mutual fund regulations enforced on them. Money market mutual funds, you can write checks on them, you can take your money out, you put in $1, you expect $1 to come out, but the money market mutual fund has to invest in only high quality, very short-term assets. They have very strict maturity regulations imposed on them. These banks basically took in money that could run, you could write a check on it, take it out immediately, and then they invested in long-term securities. So the other sort of thing to explain there, it's like the S&L crisis of the 1970s revisited. In the 1970s, savings and loans raised money from deposits where they paid very low interest rates on it, very short term, people could pull them out at will, and they invested in long-term mortgages, and the maturity mismatch ended up causing problems in the early 1970s when we had a bout of inflation, and what happened? The Fed had to raise interest rates. So you can think about it either way, and the other commonalities were the bank regulators when all this was going on. But if you had to, in a nutshell, think about what caused these 4 banks to fail, those were the issues. Raised short-term money that could run, that could leave, very cheap money when they raised it, and invested in longer-term assets to gain some yield, and then when the money started leaving the banks, they couldn't meet the cash withdrawals needed. So to tell the story, there's some background kind of preliminaries. Now, a lot of this stuff would be second nature to me, but as I started putting my slides together, I realized probably not second nature to you. So first, you need to know a little bit about bank regulatory capital rules. Not a lot, just a little. So bank regulatory capital rules are built on sort of two pillars, if you will. First, there's the idea of a bank has to have loss-absorbing capacity. It has to have capital. It has to have the ability to absorb losses. And in a normal accounting statement, we would think of that as shareholder equity. That's what the shareholders have at risk. When it comes to the banking world, they define something like regulatory capital, which is shareholder equity plus other stuff. Okay, so there's stuff on a bank's balance sheet, like subordinated debt, like reserves for loan losses that can absorb losses, so they kind of act like shareholder equity in a normal accounting statement. They're there, they could take a loss, but they're not exactly as good as shareholder equity. So they define things like Tier 1 capital, which is shareholder equity, and then Tier 2 capital, which is other stuff, which isn't quite as absorbent for losses as equity, but is there to take losses. So they've developed this complex classifications of different kinds of loss-absorbing capacity, and that goes into the rule in one way. The second piece is they look at a bank's assets and they say, well, some of those assets are really safe and some of those assets are more risky, and so they create a risk weight that attaches to different classification of assets, and they say, Okay, that's kind of a surrogate for how risky the bank's asset holdings are. And so their system of regulatory capital relates this loss-absorbing capacity to these risk-weighted assets. So mostly they're ratios of some type of loss-absorbing capacity, Tier 1 capital, Tier 2 capital. They have something called total capital divided by risk-weighted assets. And then there's another overall one that's basically equity capital divided by all assets, which is a leverage ratio. Okay, so they build it on a system of ratios based on this loss-absorbing capacity measure and this risky asset measure. And then there's thresholds. So a bank has to have a certain ratio to continue operating. If it falls below that ratio, they're supposed to close it. There's another level above that where it's considered to be a good bank, a well-capitalized bank. They have to have buffers. So they say, well, we want you to be able to go through a crisis and still be well capitalized, so they have things called buffers on top of that. So there's a whole system of these kind of minimum ratios and buffers in the regulatory capital world. It's very complex, okay? And I spent lots of years in the Basel Committee arguing about this stuff. Should it be this? Should it be 6? Should it be 9? Should it be all kinds of complicated things? And what you're going to see is it all didn't work worth a whit. It was all useless. Okay, I'm going to show you that very clearly. Then the regulators have bank liquidity rules, and since Basel II, since 2014, 2013, they have these things called liquidity coverage ratio. And the bank liquidity really focuses on something they called HQLA, or high quality liquid assets. So in a nutshell, the liquidity coverage ratio was the bank is supposed to look at its balance sheet, what it's funded with, and the different classes of funding have assumed certain percentages of them could leave the bank in a 30-day period. So the bank could experience some kind of stress, and some percentages of these kind of deposits, deposit A, deposit B, class C, would leave the bank in a 30-day period. And then it would have other kinds of longer-term debts. Some of that would disappear, and so they would use this regulatory stress test to say how much funding could leave a bank in a 30-day period. And then the other side of the requirement is, well, the bank's got to have enough HQLA to cover those losses. So the HQLA are things like Treasury securities, agency mortgage-backed securities. They're bonds that trade, have low risk weights, have a very liquid market that banks could sell quickly to raise the money to fund to replace the funding that was leaving the bank. That was the idea. You're going to see that didn't work very well either in all four of these banks. Then there's the bank regulatory examinations. Now banks big banks like these have to have a regulatory exam every year. The examiners go in. And at the end of the exam period, they assign something they call a CAMELS rating. Okay, that's the CAMELS stands for capital, asset quality. M is management. E is earnings. L is liquidity, and S is market risk. So they get a rating from 1 to 5 on each of those components, and then the examiner assigns a composite rating for the bank. One is the best rating. 5 is a really bad rating. All of these banks that failed had CAMELS ratings of all their components. None of them were worse than a 3, and a 3 is like, you're okay, you could do better. One is really, really good. 2 is you're doing a really pretty good job. 3 is, some room for improvement. 4 is you really need to improve. 5 is you're in really bad shape, and if you don't fix it soon, we're closing you. All of these banks were CAMELS rated, 3, their worst rating was a 3 on any component, and their composite rating wasn't even a 3. Well, actually, I know none of them are rated 4 or 5. I actually only know the CAMELS ratings on SVB Bank because the Fed disclosed them. CAMELS ratings are confidential, and they're not revealed to anybody. But when the Fed's report on SVB, it told us the CAMELS rating it assigned to SVB Bank, and it was CAMELS 2 up until the last exam, and that was CAMELS 3, and they never even got that letter because they were too slow in giving them the examination letter. A lot of that's covered in my Treasury report. I'm not going to go over those details here today. Another background thing we need to understand: interest rate risk. If you have a fixed fixed income asset, like a bond that pays a certain interest rate every 6 months, or a treasury bond, or a mortgage, where a mortgage has a fixed interest rate on the mortgage and it makes constant payments. The value of a fixed interest rate instrument falls as market interest rates go up, okay? If you've got a 4% mortgage and it's worth, if interest rates are 4%, it's worth $100,000. If interest rates go up to 5%, you're not going to be able to sell that mortgage for $100,000 anymore. You're going to only be able to sell it for like $95,000 or $94,000 or whatever. So interest rates, outstanding fixed income instruments, the values change as interest rates change. The decline in the market value of these fixed rate instruments is larger the longer the maturity of the asset. And mortgages are particularly complex creatures in this world, because if you have the option to prepay a mortgage, what happens is that if interest rates fall, everybody prepays on the mortgage, and so the mortgage value actually doesn't go up as much as it would have had if interest rate fell. And when interest rates go up, nobody prepays their mortgage anymore. They stay in their house, and so the mortgage value falls more than it would have. So mortgages have what's called convexity. They have the extension risk, and they're particularly important in that way because lots of these banks bought mortgage-backed securities. Regulatory capital rules do not account for interest rate risk, okay? They really only account for credit risk. That's what people thought of at the time when they put in these risk weights. They don't account for interest rate risk. And then another thing that you need to keep in mind is how we account for things on a bank's balance sheet. There are accounting values that are on balance sheet numbers, and then there's fair market values, and they're not always the same thing, okay? A bank's held to maturity security. So if I'm a bank and I buy a bond and I say I'm going to hold this bond until it matures, it's going to pay off in par. I don't have to mark that security to market when I put out my financial statements. So if interest rates go up and I own a long-term bond and it falls in market value, I don't have to recognize that loss. And the rationale is I'm going to hold it to maturity. So I'm not going to take any loss on it if I hold it to maturity, because it's going to pay me par value, okay? So I don't have to recognize that market loss if I'm going to hold it to maturity. Whole mortgage loans are the same. All loans on a bank don't have to be marked to market. Whole mortgage loans are a long-term instrument. They're 30-year fixed rate. They don't have to be marked to market, even though their true market value varies a lot as interest rates vary. So we got to keep that in mind, because that's going to play into what we see happening. Now, another thing to think about here, the bank managers, they all failed, okay? Management was bad, of course. If your bank fails, the bank managers weren't any good. We take that as a given. But we have to remember there was a time, during this time, when these risks were building up, the Fed and the Treasury were flooding the banks with huge amounts of deposits. We'll see that in a minute. Deposits were all over the place. Deposits, the government printed money and handed it out to people. The Fed, QE, bought all kinds of securities. Deposits were all over the place. Deposits were galore. Now, if a bank accepts deposits in a zero interest rate environment, that means the Fed isn't paying it any interest to keep the deposits at the Fed. It's paying very little, less than 25 basis points. So if I'm a bank and I take in a deposit and I just leave it at the Federal Reserve, I do earn some interest, but I don't earn enough interest to pay my deposit insurance premiums that I have to pay the FDIC. I have to pay employees to service these accounts. I have to pay the cost of these deposit transactions. You get free checking. The bank has to pay for that, right? So a bank deposit in a zero interest rate environment doesn't pay for itself unless you can do something with it that earns you an interest spread, right? So the Fed Reserve balances didn't cover the cost of deposits, so the banks had to go further out on the yield curve. They had to take their deposits and invest something further out on the yield curve to earn some positive net interest spread. Otherwise, the deposits are costing them money. They'd rather not have them. And some banks in Europe, when interest rates were negative, actually charged people to put deposits in the bank. They didn't. But here, what the banks did was they went out on the yield curve, bought some assets that were longer term, because the interest rates, as we'll see, were higher on longer term assets. And it created a maturity mismatch and interest rate risk. Now, the people say, well, if you're a good bank manager, they would have hedged the interest rate risk. But if you hedge your interest rate risk, you're paying somebody else to take that risk. So it lowers your net, you've got to pay for it. It lowers your net interest rate margin. So you can erase it. If I use derivatives to get rid of all of my interest rate risk, I might as well not even have bought the longer term asset because I'm paying somebody else to take that term structure risk. But that's why I was earning a spread, because I was taking term structure interest. So the banks had to do something with these deposits, okay? It didn't work out well for these 4 banks in the end, what they did with it. But it's important to have a grounding here. There were a bunch of deposits. They got a bunch of deposits. They had to do something with them. Now, what they did with them wasn't, as you're going to see, doesn't look terribly risky. They bought treasury bills. They bought mortgage-backed securities guaranteed by Freddie Mac and Fannie Mae, all government guaranteed. Or they did some other things, we'll show you in a second. But on the face of it, they were not terribly risky things. But when interest rates rose, the Fed had to raise interest rates. They took a lot of loss on these assets they bought because of the interest rate risk, and people recognized it. And for different reasons, and we'll see in a minute, they started pulling their money out of the banks, and the banks couldn't cover it. So let's take a look at the economic environment for a minute. So first of all, this is what the government spent every year, and you can certainly see the COVID spending. The first is the COVID, I guess, Trump spending stimulus, and the second one is, I guess that's the Biden 21 must be the Biden one, quarter 121. Look at the huge increase in government spending, gigantic. Okay, it's a two-hump camel, I guess. Now the Fed, when COVID hit, the Fed reinstated zero interest rate policies. Right here, here's where COVID hit. They dropped rates down to 0, or close to 0, right? 15 basis points or something. Now this is the term structure of interest rates. So every color line here represents a different maturity. So you can see that the 3-month treasury is basically 0 for the longest time. 1-year treasury, almost 0 for the longest time. You get to 5-year treasury, there starts to be a spread between a 5-year treasury and a deposit. But it's not a big one, right? 5-year treasuries are still paying less than 1% all the way out until recently, or a year ago. You go to the 10-year treasury, you're still not earning a whole heck of a lot of money, right? That's still like 1.5% above. That's not a lot of interest earning. As you guys that have money market funds or other probably know, you didn't make a whole lot of money on your investments here. Now, if you went to 30-year mortgage rate, you earned a little bit better, but it's not huge money. And this is a 30-year Freddie Mac. You or I take out a 30-year fixed rate mortgage. If you bought a mortgage-backed security, which pools a whole lot of mortgages in, the rate that those things earned are right about somewhere in here. They're lower than the blue line, which is the rate on a average 30-year single mortgage. If you pool them into a security, they're less risky, and the rate that you earned was less. But I couldn't find that in the time I had to get a picture together for you. But you can see the effect of the zero interest rate policies. And last, March 2022, the Fed started raising rates. Rates started going up. Here's where we start taking losses on long-term assets that we own, because the long-term assets we own were all purchased with interest rates back here, and then interest rates rise up, and all of those things that we bought back then are losing money, and banks owned them. Okay, the Fed QE purchases and stimulus checks, they flooded the banks with deposits. Banks are going along, here comes COVID, stimulus. Deposits jump from whatever this number is, 13,500,000,000 to 15,500,000,000. They jumped by $2 trillion in like 3 months. I mean, it's a big jump in deposits, and they keep rising as the Fed keeps going on QE. So we're pushing all kinds of new deposits into the banking system as the Fed does the QE and grows its balance sheet. Now the low rates and the liquidity, free short-term money. You remember the SPAC issuance boom? What are SPACs? SPACs are called special purpose acquisition companies. And what was a SPAC? Well, you started a company and you sold stock. And what did the company do? Well, they told you in a prospectus, well, Our job is going to be to go out and buy other companies. We don't do anything right now, but buy our equity, put some money in these firms, and we're going to go out and buy. And what were they going to buy? Technology firms. They were going to go out and buy up all the hot technology, all the cyber firms, whatever. They were going to buy up all the new wave, stuff that was going to make America great. And all you needed to do to get in at the bottom was you needed to believe in the SPAC. You needed to buy their equity. And trust them to go out and acquire good technology stocks and make you money later on. In a nutshell, that was what SPACs were supposed to be about. And they were really hot. They were really hot when the Fed had zero interest rates, started zero interest rates and pumping up the liquidity in the economy. You couldn't earn anything on short-term money, so people were looking for places to make a buck, right? You put your money in the bank, you get nothing. Put your money in a money market fund, you get nothing. Stock market, it had its problems back then. I didn't get a chart of that. But people were looking for ways to raise yield and income, and the SPACs were they were the get rich quick play. And what was the other get rich quick play? Come on, you know this.
Crypto?
There you go. Crypto prices. This is Ether and Bitcoin. What happens? Well, they start taking off as soon as the money starts floating around in the economy, right? When this money starts sloshing around, everybody gets their stimulus check, and then I'm not going to put it in the bank. I'm going to buy some crypto. I'm going to get rich, right? So the crypto prices went through the roof. Okay, it's money and liquidity. COVID money, it did a lot of things, right? Okay, all four of these banks that failed were fueled by large inflows, very large inflows of uninsured deposits. All of them faced massive depositor runs that in the end is what made them fail. All of them used short-term borrowing to fund long maturity investments. All of these things are obvious if you just look at their regulatory call reports. Now, banks have to file, I should have brought one with me, banks have to file regulatory reports every quarter. And it's a big, thick stack of papers. It's income statements, balance sheets, loan losses, securities holdings, all kinds of information about deposits and everything. Every quarter they have to file it. About 6 weeks after the end of the quarter, it gets processed by the FFIEC and the FDIC and FFIEC, and it becomes public. So December 31 call reports became public in February 23rd, February 20th, in the 20s and the Februarys, about 6 weeks later, okay? So you could go and you could see all these numbers in late February. That was about the same time that many of these banks also issued their 10Ks, their Securities and Exchange Commission annual reports. So there's a lot of information on these four banks from the end of the year of 2022 that's becoming public knowledge in late February, early March. Okay, what we're going to see from the call report data is the Basel II-III complex system of regulatory capital ratios and liquidity ratios didn't identify any problems. So some of these banks have tremendously good capital ratios, and then they failed. I mean, massively good capital ratios. You give them a prize for it, and then they failed. Banks were one of the things, if the Federal Reserve provides lender of last resort liquidity. We know that's famous, right? Badget, and when does the Fed lend? And you have to have collateral, though. But one of the things that you would think that regulators would pay a lot of attention to is a bank's ability to access the discount window if it needed to. But apparently none of the examinations paid any attention to that, because two of these banks, SVB and Signature Bank, when they were experiencing depositor runs, they couldn't get the assets that they owned to the Fed to pledge for collateral in time to get money out, because they hadn't done their homework on it. If you're going to pledge a bunch of assets with the Fed's got to look at them. It's got to decide what the haircut is on it. So the Fed, usually, it's got a different program now because of the crisis. It doesn't lend you 100%. It's got to know the market value of the asset. It then takes reduces the value it's going to lend you. It's called a haircut because the asset has volatility. And there's different haircuts for different kinds of assets. They have to evaluate it. If it's a loan pool, they got to look at the loan pool. What's the quality of the loan pool? So all this stuff isn't done just like that. Banks that are well managed would have these things pre-pledged to the Fed, so that they would say to the Fed, okay, here's a pool of loans, I don't need the money, take a look at it, decide what's my line of credit based on this collateral if I need it, and then they could get it like that. None of these banks were prepared for that. Signature Bank, you would have thought examiners would worry about stuff like that, but no. They were worried about the complex capital ratios and did they put the right, all kinds of stuff. Okay, basic stuff like that, they didn't pay attention to. So regulators failed to anticipate and exercise prompt corrective action powers. The regulators have a lot of power under laws passed after the banking crisis of the 80s and the early 90s, fiducia. They have what's called prompt corrective action powers. They can go in and tell the bank that they have to do stuff. You have to fix stuff. They can tell the board of directors they have to fix stuff. If the board of directors doesn't fix stuff, they can do all kinds of things. They can fine them. They can fire directors. They can tell them they can't grow. They can close them. They have a whole range of powers. They didn't use any of those. They didn't recognize the problems, first of all, and these problems could have been addressed with prompt corrective action powers, and they weren't. Now, when it comes to regulators, two of these banks were the primary federal regulator was the Federal Reserve, and the Federal Reserve Bank of San Francisco, and the Board of Governors, and two of the primary federal regulators were the FDIC. Signature Bank and First Republic Bank were FDIC banks. SVB and Silvergate were Fed member banks and primary regulated by the Fed in the state of California. So the first bank that got into trouble and failed was, it didn't fail. This one didn't fail. They decided they were going to voluntarily liquidate the bank. They were going to close the bank. They were going to give up their bank charter. And they decided that in March. They decided that in March right before there was a run on SVB and Signature Bank. But Silvergate Bank started out as a really small bank in California. And the way they grew is they grew with the crypto craze, okay? Now, there's this problem in when you buy and sell securities, and it's called delivery versus payment. So if I'm going to sell you my stock, you're going to pay me cash, okay? If I send my stock to you before you send me the cash, then if you don't send me the cash, I'm out of it. I'm at risk, right? If it's the other way around, if you send me the cash and I haven't sent you the stock yet, well, maybe I'm not going to send you the stock. I got the cash, you know. So there's this problem when you're doing transactions about delivery versus payment. And in the crypto world, and I didn't really realize this until I started digging into this the other day, this was a huge problem, okay? And the huge problem is because the crypto trades on a blockchain. So Ethereum or Bitcoin or whatever your crypto token, you put it in this blockchain machine and it clears whenever it clears in real time. Not, could clear 10 minutes for now, could clear 15 minutes for now, but you're going to transfer your token to somebody else. But if you sold them that token for money and you're going to use the banking system, they say, oh, well, I'll send you an ACH I'll pay you by ACH. But you won't get that till the next day in the banking system. So you haven't got the money, you haven't got the dollars for your crypto, but your crypto is already cleared and settled in real time on a blockchain, okay? And so one of the ways the crypto market dealt with that was it created stable coins. So you give your money to a stablecoin provider that backed it with supposedly with assets and everything, and they would give you a stablecoin, and you could trade the stablecoin on the blockchain at the same time you were buying something else, Bitcoin or something else. And so the stablecoin enabled you to do delivery versus payment about in real time. If I was trading like a Bitcoin for a stablecoin, I wanted to buy a Bitcoin. I don't want to send them dollars because the dollars, or I don't want to sell my Bitcoin for dollars because I don't get the dollars for a day and I don't know if I'm going to get them or not. So with a stablecoin, they could put a stablecoin in the blockchain and I would get it in the next 10 minutes too. So it takes away the delivery versus payment lag in the crypto. That's what stablecoins did. But what happens when I want to buy a stablecoin? I got to give them dollars. I got to buy the stablecoin first if I'm going to use it to do something else in the crypto world. So you've got this delivery versus payment problem with dollars because the banking system clears transactions in general next day. it doesn't do it in 10 minutes. Now, the Fed now and these other systems are coming online that are going to do it faster. But Silvergate realized this. And so what did they had a system called SEN, where if you put a bunch of deposits in the bank, they had their own permission blockchain, and everybody that did crypto would have a SEN account. And the SEN accounts, you could send dollars real time between anybody that was a SEN member. And so the bank attracted all these deposits from the crypto world for its SEN machine, because the SEN machine allowed people that were trading crypto to use the SEN to trade cash at the same time, 24/7. So it attracted all these deposits because of this clearing and fast clearing and settlement system for cash. It had to be SEN account to SEN account. Okay, that's quite clever. I didn't realize that until I started reading through all this stuff the other day. That's why they grew so much. Okay? The SEN deposits paid no interest, so we got all these deposits free. We have to do something with them. And then in 2020, they started making loans in their, they called it SEN leverage, where if you put crypto collateral with the bank, they'd make you a loan. But we can look at some of the numbers. I don't know if you can see them back there so well. Their assets in 2019, these are thousands, so that's 2 trillion. Then they grew a little bit to 5 trillion, and then they jump. When the Fed starts pumping in money in 2020, between 220 and 221, they jump by $10 trillion. They're hoovering up. These are uninsured deposits. These are big deposits. These are crypto firms putting money in there so they can use their SEN account. They hoovered them up. Look at that. That's a huge growth in deposits. Why? Because the Fed's got throwing all this money out. There's the crypto craze. Okay, so they lived and died on the crypto craze. And what happened in 2023? Right here, 9:30. FTX is still running around. They haven't arrested him yet. They arrest him in October, early November. Close down FTX. FTX, of course, people that used FTX and traded those kind of coins used SEN. Lost a whole bunch of deposits. These were all uninsured, by the way. 98% of their deposits were uninsured at the height of it. Almost 100%. They didn't have any deposit insurance. So if this bank goes down, you're going to lose all your money. Those guys are not stupid. They're not going to leave the money in the bank, and they didn't. And FTX, and then in February they got hammered with a class action lawsuit because the people that lost all their money in FTX told that bank, hey, you were doing these transactions, that was money laundering. You're responsible for detecting money laundering, and you were aiding and abetting a money launderer. We're suing you. We want our money back. Oh, a bunch of deposits left. A lot. 10 billion. Okay? The bank sold a bunch of its held to maturity assets. It took, I think, a $1 billion loss. And it said, okay, enough of this. We're going to close the bank. We're going to on ourselves. So this one didn't fail. It didn't call the FDIC anything, but that's sort of the birth and death of Silvergate. And Silvergate was a warning call for the next bank. Okay, I think I've already said all this stuff. Here's its regulatory capital. Here's its regulatory capital ratios. It's got regulatory capital ratios that are massive. Tier 1 to capital, 45%. All the assets it held were like high quality treasuries. I'm running out of the camera here. They were high quality treasuries, agency-backed, mortgage-backed securities, things that had zero risk weights or risk rates at 20%. And so their risk-weighted asset number was really small because the securities they held were considered, didn't have any credit risk because they're guaranteed by the government. But they had huge interest rate risk and huge embedded losses. So they had to sell them to meet depositor withdrawals. They lost $1 billion. And you can see the capital ratios up there. They're fantastic. I mean, those are just great capital ratios. Any regulator would look at those, and nothing wrong with this bank. yet there was. So they didn't work very well. So in March, they announced they were going to voluntarily liquidate right before depositors started running on this bank, Signature Bank. Now, the growth in Signature Bank was driven by the crypto boom. They decided in 2018, they made a business decision. They were going to set up one of these platforms like SEN. Theirs was called Signet. And, but to have money in Signet, you had to have a minimum balance of $250,000. Okay, so they said the other bank didn't have a minimum balance. I guess they didn't need one to track the money. Signature Bank said, if you want to use our Signet platform, you got to have at least 250 in your account. And of course, they had a lot more than that. And they could transfer money real time between other Signet members. So this was the same function that Silvergate was doing. It was fixing the dollar delivery versus payment problem in crypto. These deposits didn't earn any interest. Over 90% of them were uninsured. So you can see 2019, it's worth about 50 billion. 1,000 million billion, 50 billion. And the last one was billion too, not trillion, I misspoke. It's easy to tie up your words with these massive amounts of numbers that are just way beyond comprehension, right? So it jumps by, it grows 25 billion or 23 billion in a year. Then it grows again when the money starts sloshing around, and this is all driven by crypto money for these accounts. You can see that these deposits are largely uninsured deposits, which means if anybody has a whiff that the bank's in trouble, that money's going to run, and it did. And its risk-weighted capital ratios also, again, these are strong numbers. These are like the minimum on some of these is like 6, and even if it's right before it was closed, you know, its worst rating, it was 8.5. It has good capital numbers. And because these banks owned a lot of HQLA, high quality liquid assets, the examiners looked at their balance sheets and they said, these are very liquid banks. We don't have any problem with their liquidity. They got a lot of stuff they could sell if they didn't have enough stuff to sell, and they couldn't sell it quickly enough. And when they needed to sell it, interest rates had risen, so it actually cost, they lost money when they sold it. But the examiners didn't figure that into the liquidity coverage rules. Okay. On to SVB Bank. Now, SVB Bank grows not with the crypto market, but with the SPAC market. Okay? So you have all these SPAC issuance and IPOs. Big one in 2021. Between 20 and 2021, well, actually between 20 and 2021, yeah, the bank grows by 100 billion, right? It doubles in size when the SPAC boom is going on. A lot of the SPAC money, remember the SPACs raised all this capital, and the business plan was, give us all this money, and then we'll go out in search of firms to acquire. We're going to go out and buy firms. But you gave them this pool of money. It had to sit somewhere before they used it to buy firms. And Silicon Valley Bank was the go-to bank if you're a tech venture capitalist. That's the bank they all love. They had good venture capital parties, good tech parties out there in California. That's where the cool tech people like to bank. And so the money ended up there, and it was mostly almost all uninsured. 95% of it practically was uninsured. This is hot money. If there's a whiff of any kind of stink about this bank, these guys they're smart, and they're all on their cell phones all day long. These are tech guys in Silicon Valley. They got 3 Apple phones going there. One buzzes, the other, it's hooked. And they did. They ran 42 billion one day and tried to run 100 billion the next day before they were closed. I mean, these were massive depositor runs. Again, here they took a lot of these uninsured deposits and they put them into bought securities to get some yield. But as the Fed started raising interest rates, these things had a market value that was a big loss, right? They lost 15 billion according by their 12/31/2022 balance sheet. This basically ate up, I think I have the next slide, ate up all of the bank's capital. So their mark-to-market losses on, I think it's in the next slide, I'll go back to that one. Their mark-to-market losses on their held-to-maturity securities basically sucked up all their total equity. It was actually negative. If you looked at their balance sheet equity number, and you looked at the losses on their held-to-maturity securities, they had negative capital in September 30th. This is from the call report data. You can see it on the call report. Okay, now, these losses, these held to maturity losses, are not reflected in the regulatory capital numbers. So the bank still had good regulatory capital numbers. Why? Because the held to maturity securities are held at amortized cost. They're valued at amortized cost on the bank's balance sheet. They don't mark them to market. Okay, they don't have to mark them to market. So even though on a liquidation basis they were insolvent, clearly, the regulatory capital numbers look pretty good. So your bank examiner, if you're looking at these things, they got good regulatory capital numbers, boss. What am I going to do about it, right? But, you know, and these are high quality liquid assets. These are supposed to make the bank liquid. What did they do? They lost the money. You know, and people started realizing this. They started looking at it. Their financial statements came out in late February, about the same time that the call report did. And the financial statements for the holding company, and people noticed that they had, you know, these huge mark-to-market losses on the bank, and they ran. And that's the biggest run to date I'm aware of. $42 billion in one day, I think it's back here, on March 9th, and on March 10th, $100 billion tried to leave. Now, how many deposits did they have? You know, they had 161 at the end of the year, and basically 142 tried to leave in 2 days. Now you can have all the liquidity stress tests you want, but if you're gonna require every bank to say, well, assume 95% of your deposits want to withdraw within 2 days, how are you going to run a bank? I mean, you can't run a bank. That's a money market mutual fund, right? You have to be like a money market mutual fund where you only invest in treasury, 3-month treasury bills or something like that. You know, you can't be a bank and make long-term loans and buy securities if you have to forestall a run like that. Okay, and the regulatory capital numbers, again, were good. They had a lot of high-quality liquid assets according to the rules. So they got they didn't get a bad liquidity rating. They got a management 3 rating towards the end, but they were rated, highly rated. KPMG, interestingly enough, was the auditor for all 3 of these banks. I don't know about Silvergate. I don't know. But KPMG was the auditor of Signature Bank, SVB, and First Republic. The auditor of all of them. It gave them unqualified audit reports in their annual statement. They were no risks. And I know that KPMG is worried they're going to be sued, of course, but again, the regulator didn't say the bank had a problem. So why is the auditor supposed to say the bank had a problem? I mean, the regulatory had them rated okay. The regulators had them rated okay. So we can sue the auditor and say, but the auditor didn't see these problems. But then the auditor's going to say, well, but the regulators said they were okay too. So, I mean, what do you do about that? I don't know. We may find out. I think we will find out. People lost some money. Now, in SVB and Signature Bank, the FDIC, the Fed, and the Secretary of Treasury conferred, and they said we have a systemic risk exception. Because of these banks were big and they were failing, all these other regional banks were experiencing deposit runs because they lost confidence in the banking system, in the regulatory oversight of the banking system, or wonder why. They lost confidence and they were starting to run other banks. So they voted for a systemic risk exception, which they can do. And that means the FDIC doesn't have to do a least cost resolution of these 2 failed banks, SVB and Signature. And instead of that, what they agreed to do was they agreed to insure all the deposits in these banks. Okay, now think about this for a minute. Almost none of the deposits in Signature Bank or SVB were insured. Call report, 95%, over 90 of deposits were uninsured. They weren't supposed to be covered by government guarantee. Those 2 banks would have cost the FDIC nothing to close under the normal least cost resolution test. There are plenty of assets there to pay off the deposits that were insured. 95% of the deposits in both of those banks were totally uninsured. And the Secretary of Treasury, Fed, and FDIC voted to insure all of them. All of them. Okay? Now, to stop a run, so-called run in the rest of the system because, well, they didn't trust they were safe and sound anymore. Well, maybe for good reason. But think about that. These would have cost nothing. Instead of that, SVB is like $20.5 billion, the biggest, most expensive bank failure ever. Silvergate was around $2 billion. So it went from costing the FDIC and taxpayers, basically, because we pay for deposit insurance premiums through our bank, not earning money on our bank accounts, to costing us a whole lot, which is kind of strange. Okay, the ratios were all good. First Republic Bank. I'll get to wrapping it up pretty quickly here. Their strategy for a long time was to attract wealthy clients and to put the body hug on them. You get a wealthy client, we'll give you a really good mortgage on your multi-million-dollar California property with the pool and the spa and the statues and stuff like that, but you've got to give us all your money and we'll do your wealth management for you. Okay, so we want all your money back and we'll give you a very favorable mortgage that you wouldn't get anywhere else, and the rate will be low, it'll be interest only, and Jeff Zuckerberg and all kinds of those kind of people had accounts with First Republic, and they set up branches in all kinds of rich places, Palm Beach, all around San Francisco, Silicon Valley, out in Napa, the wine country, and a bunch of prominent, basically Democrats, had their money in this bank, and they were. Okay, and for the mortgages, okay, so you're back in a few years ago, interest rates are nothing, you're not earning anything on your money, so if somebody comes to you and says, I'll give you a really, really good deal on your multi-million-dollar mortgage, you pay almost nothing, all you got to do is give me your money, and you're not making any money on that, let our bank manage your money for you and we'll take care of you, and you're not making any money on that anywhere somewhere else because the interest rates are so low, so okay, I'll go take the mortgage, I'll take the body hug, give them the whole Megillah. And that was their strategy, and that's what they did. And they grew a lot. There was a lot of money sloshing around. They attracted it. And again, because these were relatively rich clients, they had a lot of deposits were way over the deposit insurance limit. 80% of their deposits were uninsured. And same story. They invested them in longer mortgages, long maturity bonds. And this is from their annual report. They lost their shirt on all of them when interest rates went up. They had unrecognized mark-to-market losses of 13. I think that's these are in millions, so that's millions. $13.3 billion they lost on their securities portfolio between December 2022. This is the carrying value, this is the estimated market value, that's the gain or loss. So they lost $13 billion. So people, when they saw the other two banks fail, started pulling all kinds of money out of this bank because they had uninsured deposits. I want to go back a little bit. They replaced these deposits by borrowing huge money from Federal Home Loan Bank. They pledged the securities. I think they got $28.1 billion from the Home Loan Bank, and then JP Morgan put together a $30 billion consortium of other banks to deposit money in there, and it sort of stabilized First Republic for a couple of months, and then in May they were closed and sold to JP Morgan. Okay, so I think from a lot of this you can see the commonalities. Again, this bank had good, I don't think I put up their regulatory capital numbers, but they had good regulatory capital numbers too, and they would have had good liquidity ratings too because of the bonds they held. So I hope I've painted a story where you can kind of see some of the similarities and what went wrong in these banks. So why did these banks take on so much interest rate risk? Well, they needed it to make the deposits profitable. They had to go out in the yield curve to earn enough yield to get a positive net interest margin. The Federal Reserve for years was issuing guidance that said rates are going to stay really low for a long, long time. And I'll show you a picture of that in a minute. All their regulatory capital ratios were strong, although they did not account for interest rate risk nor the mark-to-market losses on their loans and held-to-maturity securities. They got good CAMELS ratings. Presumably, the only one we know about for sure is SVB, but the other ones were not on the problem bank list, which would be CAMELS 4 or 5. I know that because they would have been identified, and they haven't been. And aside from Silvergate's the only bank that had any kind of loss. They had a loss in the fourth quarter when they had to sell a bunch of stuff. They had $1 billion loss. None of these banks up until March had sold any of their securities and realized that mark-to-market loss. So they weren't showing negative cash losses. So here's the FOMC guidance. I split it up into 2 periods. So this is their forecast of what the policy interest rate, the federal funds rate, would be at different points in time, right? And these are different FOMC meetings. So you can see in June of 2021, they said, well, rates are going to stay like just barely above the Fed funds rate. Even this is in 2021. They said 2 years from now, it's only going to be a little over 0.5%. And then in the next meeting in September 21, we're already going through inflation now. Inflation started in March of 21. They raised it up, but still, this is below. In 2024, in September 2021, the FOMC said that we don't think it's going to go higher, as high as 2% in 2024. By 2024, we can keep inflation under control, keep interest rates really low. This is their forward guidance. Then, December 21, oops, their inflation's going on a little longer. They raised their forecast, but still, in 2024, the highest rate is 2%. That's still not. They would still be. Their securities would still be above water at 2%. Probably most of them. Then you come to the other FOMC meetings, the March 2023. Well, the March 2022 through 2023. It progressively gets worse, and the Fed finally starts to admit, yeah, interest rates are going to go higher, and they're going to be higher for a longer time. But for the longest time, the Fed was broadcasting, hey, interest rates are not going to be high. Hey, we're not worried about it. Inflation's going to be under control. So, did the bankers think this was going to happen? Or, well, I don't know. Should they believe the Fed or not? But the Fed wasn't very good at forecasting where things were going to go, as you all remember. Were the regulators fooled by the complexity of their own capital and liquidity rules? I think so. I mean, they spend all this time, all these complex calculations on this stuff that was worthless in identifying any of the problems in these banks. All of this stuff, all of these complex capital rules and risk-weighted asset calculations and liquidity coverage ratios and all this kind of stuff. The stress test, they say, oh, the stress test. Well, the Fed stress test had rates falling in a recession, not going up, falling. It didn't show anything. All those complex rules, all that money they spend and force banks on, it didn't identify anything. Okay, so yeah, but you got a million of these guys, not a million. You got hundreds or thousands of economists and examiners looking at all these complex rules and making sure the number's exactly right to the second decimal place. And it's a very sophisticated regulatory scheme, but don't confuse sophisticated with accurate. But I think we do, right? It's really complex. It must be able to detect this stuff. Look at how much calculations go into that. It's all nonsense. All you needed was somebody to really look at the call reports who understood banking. You could see what would happen if interest rates went up. Okay, I just showed it to you. I didn't use any complex models. I looked at the call report and basic understanding of how fixed income products work and the regulations work. The FSOC in November of 2022, it was one of those Novembers, after Yellen became Secretary of Treasury, which would have been November 2021. Told the banking, hey, you got to worry about climate change. It's a systemic risk. You got to worry about that. You got to focus on that. So the Fed and the FDIC, they were focused on figuring out how to measure climate change systemic risk in the banking sector. A bunch of the Fed presidents were also focused on ESG, and I guess they call it DEI, but I call it DIE issues, diversity, inclusion, and equity issues. And the San Francisco Fed, shock of all shocks, was one of the very most active in both of these areas. And I just spent like 5 minutes this morning and Googled the San Francisco Fed website, and here's 4 or 5. They had a whole symposium on system climate change meeting. They had met for days there. They were all studying systemic risk while interest rate risk was killing 4 of the biggest banks, 4 biggest banks. They were all worried about whatever, floods or wildfires or I don't know what. Where were the regulators? Okay, did senior Fed and FDIC officials allow examiners to do their job and proactively impose strong corrective action measures? Now, I worked at the FDIC for almost 10 years, and I worked with bank examiners. I was a models guy, so my guys went out and looked at all the kinds of fancy models that went into capital rules. And, you know, some of those bank examiners are pretty sharp, and they recognize problems, but the higher-ups don't always let them you know, beat up on the bank. You know, they might say, hey, we got problems. Well, there's no losses yet. Can you prove it? I'm not going to let you downgrade them when nobody's losing any money yet. Look at their profit numbers are good. How can you say that? What happens if you're wrong? There's all kinds of second guessing. You know, examiners can only do what the higher ups let them do. You know, all four banks were, quite frankly, in Democratic donor strongholds, right? California, Signature Bank is New York and Massachusetts, and First Republic was California, Palm Beach, New York, and Massachusetts. Michael Barr and Marty Gruenberg have a history of political regulatory agendas. I mean, that they do. There's no doubt about it. They were not focused on basic banking system risks. You know, Marty Gruenberg is famous for Operation Choke Point, where he wanted to, you know, bankrupt gun shops and anything the Obama administration didn't agree to. And some people say Operation Choke Point 2 is on Brown Industries. You know, Barr, you know, as soon as he came into office, he started his holistic review of capital requirements, which was to overturn the Quarles tailored regulations, where they said, you know, some of the smaller banks don't need to do all the nonsense the big banks do because they don't really have all the same risks. You know, you should tailor the regulations so that the costs of regulation are more in line with the benefits. And then he was all about imposing new climate change stress tests and capital regulation, and he's going to roll that out any day now, and you'll see that's exactly what he wants. That was his mission. The SVB, Signature Valley Bank CEO, was on the San Francisco Board of Directors, okay? Barney Frank, Senator Barney Frank, one of the authors of the Dodd-Frank Act, and Senator Alphonse D'Amato from New York, who used to be head of the Senate Banking Committee, were both on Signature Bank's Board of Directors, those two powerful grandfather Democrats. So, you know, is there any relation here between political connections and not having strong corrective action? I'll let you guess. I don't know. That's all I have. I hope you learned something. I hope it was a little entertaining. I hope you're not too depressed. So, are there other banks in the system that have some of these problems? Sure. To the same degree as these banks, I don't know. I haven't looked at all the banks. There's only one of me, and you know, you pull the data, look at it. It's not like I have. You know, I have to go pull the data from the FDIC website just like any mortal and download it and digest it and put it in a spreadsheet and look at it. So I haven't. There are people that have sort of run the whole data for the whole banking system and say, yeah, there's a bunch of banks that have problems like this. Are they as bad as, are the problems as bad as these banks? Probably not to the same degree, but the things that went on in these banks went on in other banks. And yeah, so is the crisis over? They got it under control for now. There's a lot of banks that probably have portfolios that are underwater. And if people maintain confidence and don't pull their deposits, maybe they'll pull through it. Interest rates will come down. A lot of it's a confidence game. If your depositors aren't paying attention and don't, you know, trust the bank, then they're not going anywhere. You probably hang on and survive. Depends on how high the interest rate goes. The Fed has to push interest rates and for how long, but that's anybody's guess. So.